For retirement accounts, however, things look a little different. I would say that my preference is for each person in a relationship to have investments in their own name or to which they have some ownership. So for non-retirement investments, that is settled by you just making sure that you have ownership in the accounts that we just discussed. With retirement accounts, it's not always possible for a stay-at-home spouse to have investments in their name from a retirement perspective. If you're a lower income earning spouse and you have a plan available to you at your job, then you can obviously participate in your workplace plan's 401k, your 403b, and I would encourage you to build yourself up to the point where you're at least contributing enough to get any matched dollars offered by your employer. So if they say that we'll match the first 3% of your pay that you put in, at minimum, you want to have your goal be putting in that 3% of your pay. Otherwise, you're leaving money on the table. If you work at a place that doesn't have a workplace plan, you can contribute up to 100% of your pay to an individual retirement account as long as, if you're under 50, that contribution doesn't exceed $7,500 in the year 2026. If you're over 50, you can do what's called a catch-up contribution and you can contribute up to $8,600. And if you're a self-employed person, you can establish a great many types of plans for your retirement earnings. You can do an individual IRA, a Roth IRA. You can do what's called a solo 401k, a simplified employee pension IRA, a cash balance pension plan. There are tons of things that you can do based on the structure of your earnings and how much you want to put aside. But if you are a stay-at-home spouse, the complication is the income earning of your spouse and also whether they're considered an active participant at their employer. If you're looking on screen, you're looking at the tax tables that are distributed to CFP candidates who are about to sit for the Certified Financial Planner exam. These are from the tax year 2025, and you'll see a section here that says IRA deduction phase out for active participants. An active participant is someone who has a retirement plan available to them at their employer. Doesn't matter whether or not they use it. If they have one available, they're an active participant. At the bottom of this section, you'll see a line that says spousal IRA. So let me explain what a spousal IRA is. Typically, you cannot contribute to an IRA, an individual retirement account, if you don't have earnings. Now, if you have earnings, you can contribute 100% of those towards your IRA. But if you don't earn an income outside of the household, you can't take any money and contribute to an individual retirement account. It's based on what you made. Now, if you're married and your spouse has earnings, you can use those earnings to justify your contribution to an individual retirement account, and that's called a spousal IRA. Unfortunately, however, if your spouse earns too much money, your ability to contribute to that account could be phased out, if not eliminated. You can see from 2025, there's a phase out range that says your ability to contribute to a spousal IRA is reduced if your adjusted gross income as a household is between $236,000 to $246,000. If your adjusted gross income is above that level, you can't contribute to a spousal IRA at all, which means there's a scenario where if your spouse earns so much money and they're an active participant, you cannot even open a retirement account in your name. And while that may be discouraging, it increases the importance of you adding to your financial conversation. How much are you contributing to your workplace retirement plan? Are you taking advantage of the match? Do we have money in our budget to potentially max out your 401k or 403b? Because you make so much money that I can't have an account in my name. So I want to make sure that you're contributing enough because that retirement account has to cover both of our needs in our latter years. And I get it. If you're listening to this, investment accounts are more complex than most people want to deal with. Hopefully, I'm talking to someone who is already well versed in this. But if you're listening and you're not, these are basic pieces of information that you will have to know, especially if you're in the driver's seat with no one riding passenger.